Hello friends and welcome to my YouTube channel Simply Stocks, and today I'm going to talk about an interesting consumer company, S H Kelkar. Whether it is worth looking or not, let's understand. So let's get started. First of all, a disclaimer that this is not a stock recommendation, and people taking any position into any share that I talk about should do that with their own due diligence and research. And I'm not in favor or against any company that I talk about. Before I talk about S H Kelkar, here's a small request that kindly support me on Patreon. Once you do that, it will help me grow the channel. It will help you also ask me questions on a daily basis. Once you get the $10 membership, you'll have access to my portfolio, my watch list, and a number of podcasts that I put up every week, 2 to 3 podcasts. If you want direct contact with me with the number of stocks that you're having currently, you can directly email me and we can work things out there. Now about S H Kelkar, the company was established in 1922 and they provide fragrances and aroma products. Serves consumer sectors like skincare, hair care, personal care, fabric, etc. So whatever smells and fragrances that goes into these products that are also being exported or provided by S H Kelkar, operates across India and abroad as well, have manufacturing facilities in India and the Netherlands. The market cap of the company is around about 1,000 crores, so it is a small cap that we are looking at into the consumer domain, but has not been doing that well. So we need to understand what has been the issues and whether one should really get in at this point of time and things are turning or not. So if you look at the financials of the company, and these are Q3 numbers. The Q4 numbers were not out till the time I made the presentation. So only a 1% rise in sales, which should have been better. There was no pandemic, nothing happening at that point of time. But there has been a 40% gash on profitability, and this is the trouble that the company is facing. Maybe due to heavy competition, maybe due to other products coming in from cheaper say manufacturers across the globe, and they are getting more market share into S H Kelkar's business. But the bottom line is that the PAT has dropped by around 40%. Debt, there is debt and high debt on the books, and that has to reduce. So reduction in profitability, reduction in operating profit margin, and you have a situation adding to that is the high amount of debt, and that is what the customers do not like, that is what the investors do not like. High promoter and institutional holding and only 6% free float is fine, but if you ask me, if there is a company which is into the consumer domain with debt that has been that is relatively high and profitability is not matching to what it should have been, then I would avoid such a company. But the valuations at the moment is such that one can even look at it. So let's continue and understand whether the valuations command something that we should look at the stock or not. Before that, I want to look at the stock performance. So stock has underperformed over the last 4 years. Ever since it has come out with the IPO, it has lost 90% of its value. So uh, when it was at the lows at around 50 or 45 rupees, it was trading at 450 rupees after the IPO in 2016. But now it has dimmed down to only about you can say 45 or so. But then the recovery has occurred, so it has recovered over 60-70% from those lows, and currently trading at 70-72 rupees. So the recovery has been good, around 60% recovery from the lows. And see, debt has kept increasing over 4 years. Performance and profitability has kept reducing. So this is a complete you can say mirror image of a chart that you can see with respect to a DMart, etc. That marquee stocks that you talk about, they keep rising because their debt keep reducing, and they keep paying debt, and so many other things. Whereas these companies which with rising debt and lower profitability uh, keep going into trouble. results have remained inconsistent. Couple of quarters go really well, other two quarters not that well, and we've seen how the results have been for Q3, which has been very, very unsatisfactory. Economic condition that we are prevailing at the moment here in India and abroad, and with in many sectors, you can say exports are being hindered. There are issues with the supply lines. Plus, there are issues with some of the bans that are taking place for export of products and people as well. People going out and all that, and with flights getting interrupted, freights getting interrupted, I think their exports will be hurt in the first quarter that we are in at the moment, or that has just passed. So low return ratios is also a concern, and I think situation as a overall may not change for the next 6 months, and that is why, that is the most important thing why people or large investors or HNI players are not looking at the stock with some gusto. But if you look at it, why I believe this is a dark horse is it is a consumer requirement. So when you talk about fragrances and aromatics, it is a requirement in all consumer products. It is a requirement as a product for taking care of oneself, and when people go out and etc. So on a concept basis, it is a very good stock. So I can, you can say, compare it to a Kaya, which is into skincare, and the product as well as the business is extremely good, but the numbers are not coming, and that's why the stock is in complete disarray. This stock is also, the concept is good, the product is very good, and I believe that the business would do well if it is run well. I think that there are operational issues with this business of SH Kelkar, and that's why probably the numbers are not coming out. Uh, Probably you would do a better research if you can delve down into how the production line is, or how is everything is being done. But that is extremely difficult for we retail investors to find out. What we see are the numbers, and the numbers tell a story that the company is not doing well. But why I believe it is a dark horse, it is into consumer play. Disposable income will keep increasing once things settle down from FY22 onwards. Then they'll spend more on aromatics, etc. Global sales growth would pick up once things normalize again, and there is definitely a valuation comfort. So if things really get going and performance start coming in consistently, the stock is trading at very, very low valuations and very attractive valuations at the moment. This is a product for the masses, and once things really means, the point here is probably the product itself, it does not command that value in the market, and the market share of the company is not that great compared to other companies that are selling the same product. And once they gain the market share, only then the company would start performing well, and probably doing well on the numbers front as well. If you look at the technicals of the stock, then stock is in severe bear grip. May have seen the worst below 50, but it is not recovering that greatly. So it did come, currently is at 70-72 levels. The short term support lies at around 60. The 200 DMA is around 90 rupees, and that is a strong resistance. So once it crosses 90, only then one can look to add the stock, and there could be a good consistent momentum. So what needs to be done? In my opinion, you can buy above 90 rupees. There's a 200 DMA. Keep track of numbers. If you're holding it, kindly hold it. Probably if things normalize over 1 or 2 years, this stock will perform. And it is a concept stock. You have to hold for 5 to 7 years if you're looking to get into such a stock. And do not have more than 5% exposure. So this was my video on S H Kelkar. Please like and subscribe my channel and hit the bell icon so that you can get my videos straight away when I post it. Thanks a lot for watching.